Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today, I want to talk to you about a tax strategy related to capital gain. So, if you are considering selling an appreciated asset, whether it's an appreciated stock, whether it's real estate, whether it's selling your business, and you have a huge capital gain, this is a great strategy for you to be able to minimize this capital gain and come out of the game very happy and winning the game. What am I talking about? I'm talking about the charitable remainder trust. How does that work, and what does that mean, and who's it good for, and maybe and who's it not suitable for, and they can skip it. This is what we're gonna talk about. So let me share my screen, and we'll try to break it down in simple terms so you know how to follow. And if you have further questions, we can discuss it together. All right, so as you know, I always like to start with a joke, and I found this cartoon to be funny because this doctor is being hit by the capital gain tax. So, what is the deal? Charitable Remainder Trust is a powerful strategy for business owners and investors who, as we said, either invested in stock or real estate, and they have an appreciated asset that they need to sell at certain point of time. There's multiple strategies, and this is one of them to help you reduce capital gain tax while supporting charities. So this would be suitable for those who already give out to charities or who have this giving mentality in their mind all the time. It doesn't bother them, and it's part of what they do and part of what they like they do on a yearly basis, and it helps generate lifetime income tax efficiently. And we're going to see how that works. So again, why the CRUTs or the Charitable Remainder Trust matter to business owners? It's perfect for those already giving to charity, as we said, and it helps you to avoid large tax bill when you sell your appreciated asset because it turns a taxable sale into a lifetime income. And we're going to see how that works. So first, you need to donate the appreciated asset to the CRUT before the sale. So if you're considering selling in 2026 or in, let's say, next month, you need to make the donation prior to the sale. So if it is after the sale, it doesn't make any sense. You need to donate the asset to the CRUT before the sale. The CRUT or the Charitable Remainder Trust is the one that sells the asset, and they're tax exempt, so they don't pay taxes on the capital gain. And then the trust reinvests the full proceeds into investments, and you as a beneficiary, and you can name anybody to be the beneficiary, they receive lifetime or term income, depends on the type of trust. And you name a charity to receive the remainder at the end of the term or the lifetime. All right, so this is in simple terms. So let's dig in a little bit more. So the first step, as we said, you contribute appreciated asset. So if you have a stock, real estate, or business interest, you contribute that into the trust. And then so that then in essence, it removes the asset from your taxable estate. So that also help you with the state taxes, not only with income taxes. And it creates an immediate charitable deduction. So you, as a donor, gets an immediate charitable deduction for the appreciated asset that you given to the trust. So it helps you with your tax saving year one. Then we said the CRUT or the trust sells the asset. And the trust, because it's tax exempt, they don't pay capital gain tax on the gain on the sale. The full sale price is then reinvested inside the trust, allowing the asset itself to even increase in value even more over the years because you keep reinvesting it. And so that definitely provides significant tax leverage compared to selling personally. And we're going to see a comparison example in a little bit. All right, there are there are different types of trust. There is the charitable remainder annuity trust, and there is the unit trust. So depends on either one. You receive an annual income, and if it's annuity trust, you receive a fixed annual payout. So let's say you receive 100K. Depends, of course, on how much we're talking about. So, but it's a fixed dollar amount, fixed annual payout. If it's a unit trust, then you receive the percentage payout. And a percentage payout means like you get paid you get paid like let's say 5% or 10% of the assets of the trust. So if you put in 100K, you take a percentage of this 5%. Next year you're reinvesting it. It's still reinvested, so the 100K is become 200K, depends of course on the investments, or even a 105, 150. You take a percentage of the 150 and so on. So it's a little bit of different amount, depends on the assets value of the trust at the year end. And the distribution follows the IRS four-tier taxation rule. So there is a different taxation rule, depends on the distribution. Some of it is considered taxable when you take the distribution. So it's more of a deferral strategy than a minimizing altogether. But it definitely mitigate a lot of it, and it gives you savings because of the deduction in year one. But you still pay some capital gain when you receive the distribution, and some you don't pay some of the distribution you don't pay taxes on. Depends on what is this distribution composed of. Is it only the principal that you put in? Is it principal plus interest and dividends that you gained on the investment, or what exactly is the distribution is made out of? All right, so that's the third step. Fourth step, as we said, that at the end of the term, that's what's called the remainder. The charity get the remainder. So after your lifetime or a fixed term, again, depends on the type of trust, you choose a charitable organization that will receive the remainder of the assets that's in the trust. All right. And you can reserve the right to change charities, and you also can change multiple charities. Doesn't have to be only one. All right. So why those charitable remainder trusts is why they greatly reduce taxes? Because as we said, it eliminated immediate capital gain on the sale. You receive a charitable deduction that can reduce your taxes in year one, and sometimes it's worth at least 10% of the value of the assets you put in the charitable remainder trust. And it reduces your estate taxes because you remove the assets from your estate. And the taxation on income is spread over many years because you don't take the distribution altogether. You don't like realize capital gain in year one. You distribute it, you put it in the trust, and you take it on a lifetime or on a number of years. So every time you take some of the distribution, you pay some of the gain on capital gain on this one, on the distribution. So it's spread out over many years, which makes it at a lower tax bracket. Okay. All right, so let's give an example, like how Kathy turned like $5 million into 19.6 million. So Kathy here had a 5 million startup equity with a 50K basis. Like they went on, like her company went through IPO, they went public, and now she has a 5 million equity, and she doesn't have any basis. So she has basically $5 million in capital gain. So before she went ahead and sold the stock, before selling, she contributed those shares to a CRUT, Charitable Remainder Unit Trust, and as we said, she received a charitable deduction maybe around 10% of the share value, so about $500,000 charitable deduction in year one. Here, she's avoiding about 1.6 million in capital gain taxes. So, but she's gonna be taking, let's say, up to 11% annually, also depending on the trust structure. It could be 5%, it could be more or less than 11%. And this allow her to withdraw and take like an annual income of 11%, or up to 11% annually of this $5 million. So if like when we calculated the lifetime payout for her, and this is something that you will see for yourself when you do the analysis, you will see over your lifetime how much the CRUT can pay you. And in this case, the lifetime paid her $19.6 million. If she had sold it in a taxable account, she would only have got 8.7 million. But so the net benefit here that she kept about 10.9 million more. So even after donating to a charity, the remainder of the assets that stayed in the account, she ended up with 10.9 million more. So that's the power of this strategy, because again, you keep reinvesting it, you keep earning more on the investment over the years, and depends on the investment selection, and depends on the number of years, depends on the tax savings and all of that. She ended up being having more, about 10 million more than it would have been if she sold it in a taxable account, assuming that she also invested this 5 million in other investments. All right, so this is definitely a no-brainer, simple tax strategy that dramatically increases the long-term wealth. So I personally see that it's a great investment strategy, even if you don't like donate to charities. But if you donate, even better, because it brings you a lot of tax saving. But also the numbers matter. So depends on your situation, depends on what numbers we're talking about. This can make sense or may not make sense. So depends on your situation. And as we've said, there are two different types. There's the annuity trust, there is the unit trust, and the unit trust has multiple forms as well. But the main difference is that the CRT gives you fixed amount, predictable income. The CRUT gives you fixed percentage. So it grows with the investment. You receive a different amount every year. You can structure to control how much you can get, but just generally speaking, and it's inflation friendly. Most business owners prefer the CRUT flexibility than the CRUT. And again, because it grows and it's inflation friendly. Who benefit the most from those type of trust? Again, we said if you're a business owner selling your company, if you're a real estate investment with highly appreciated property, or if you're an investor with a low cost basis stock, and if you're any one of those who already give to charity annually, then you can benefit the most from those type of trust. If there are risks consider or that we need to consider, it's an irrevocable structure, so you really can't reclaim the asset. After you put in the asset in the name of the trust, you can't take it back. So once you do it, it's irrevocable structure. There are definitely strict IRS rules and minimum payout requirements. You can just say, okay, I'm going to skip this year. I'm going to take 1%. There are certain rules around that. And it requires administrative and investment management costs because your money will be invested. So there is an investment management cost involved. There is administration cost involved because you need to have a trustee for the trust. So you need to consider all this together. All right, so if you are a charitable giver, then that means you already give. So just you now need to do it strategically. This strategy allow you to keep lifetime cash flow, and it eliminate or reduce your capital gain taxes, and it helps you leave a meaningful charitable legacy. Next step, get a CRUT or a trust illustration for income plus tax savings. we can like any investment or anyone that does that, they help you. They give you this illustration with the numbers based on your situation to tell you if it makes sense or not. You need to coordinate with your CPA, attorney, and advisor, and you need to choose the right asset to invest in and the right payout rate, and the right structure. So all of this needs the right person to partner with to help you navigate this and to help you choose the right one for you. All right, so here's my calendar link again. If you need to ask more questions about it, if you want to consider it, if you think you still have questions about whether this apply for you or not, please reach out and I'll be happy to assist you. All right, thank you and enjoy the rest of your night. See you next week.